With the current geopolitical uncertainty and the recent election of Trump, Forex market and gold experience wild price fluctuations. These unpredictable swings can result in substantial losses in trading, especially for the beginners. In this video, I will share with you the essential trade management and risk management tips for dealing with the high volatility in trading. I will reveal the proven strategies and techniques for avoiding losses and unexpected risks. Please don't forget to like this video, subscribe to my YouTube channel, and learn how to survive any storm in the financial markets. Rule number 1. Pay attention to the news. The main source of the extreme volatility on the financial markets are the news, especially the bad ones. Moreover, in times of uncertainty, the frequency of the occurrence of the bad news increases dramatically. And that is a very big problem for traders. Such news may easily invalidate even the best technical analysis trading setup. Any powerful support or resistance level, strong candlestick or price action pattern can easily be invalidated by the bad news. Just examine how $CAD reacted to Trump tariff threats. First, the price went up by more than 400 pips, and with this bullish movement, the price completely neglected all the significant resistances. Then the sudden change of his rhetoric made the market drop by more than 500 pips. And again, all the key supports were completely neglected by the market. The fundamentals here completely invalidated all the technicals. Watch how I treat high volatility in my trading academy, join my VIP daily live streams, and learn how to trade. For more info, check the link in the description below. When you are holding the active trading position, never forget to check the news. When you see some impactful news that may affect your trade, take your stop loss and move it to entry. Doing that, you will protect your trading position. If the market starts moving in the opposite direction, you will close your trade on entry, making zero loss. Even constantly monitoring the news, you cannot protect yourself from all these surprising movements. And sometimes, because of the bad events, your trades will be closed in a loss. Therefore, I strictly recommend measuring the lot size for every trade that you take. Make sure that you risk no more than 1% of your trading account per trade. That will help you to minimize losses caused by the impactful uncertain events. High impact news events may also occur on weekend when the forex market is closed. Such incidents can be the cause of huge gap openings. If you decide to hold an active trading position over the weekend, remember that your trading account can easily be blown by such gaps. Imagine that you decided to buy euro-dollar pair on Friday during the New York session, and before the market closes, the price did not manage to reach your take profit and stop loss, and you make a decision to hold the trade over the weekend. This huge gap down opening that the market formed on Monday after the market opening would lead to substantial losses. If initially the stop loss for the trade was 27 pips, with this gap, you would lose more than 125 pips, causing these substantial losses. In order to avoid such gap openings, I recommend not holding the trades over the weekend and re-enter the trade only after the market opening and only in case of the absence of the gaps. By the way, the day when the markets formed these crazy gaps on major and minor forex pairs and other financial instruments, I received a lot of messages from my followers that their trading accounts were completely blown by these gaps. So do not hold your trades over the weekend. If you see a significant price movement caused by some events and you did not manage to catch it, let it go, because quite often a correctional movement will follow quickly. It will be much better and safer to wait for a pullback first and then look for a trend following movement strictly after a pullback. Look at the price action on gold. Though the market is trading in a strong bullish trend and though the market is driven by strong bullish fundamentals, still there are a lot of pullbacks. And being patient, you can always wait for a pullback. Pullback will give you the safest and the best entry for catching the trend following movement. So always be patient and wait for a pullback first before you open the trade. In the midst of geopolitical tensions and trade wars, the markets tend to rally or fall for very extended periods of time. The best trading strategies to use to get maximum from such movements are the trend following strategies. While reversal counter-trend trading strategies can be very risky and can provide low accuracy and a lot of false signals. While the trend trading may bring the extraordinary profits, the counter-trend trading is the path to the blown trading account. A current bullish trend that we contemplate on a dollar CAD pair lasts for more than 5 months already, and the market may continue growing for 5 months more. Such rallies, such trends can last for years. And of course, trend following buying should be your main priority here, while you should think twice before you sell. These trading tips are tailored for cutting losses and avoiding risks during the dark times. Empower your trading strategy with this knowledge, and good luck to you trading Forex and Gold during the high volatility. Let me know, traders, in the comment section if you have any questions. Also, traders, if you want to learn how to trade, if you want to see how I trade live, if you want to see how I trade highly volatile market, do not forget to check my trading academy, the link in the description below. Also, traders, please watch my other videos.